Welcome back to Investing Talk podcast. Today, we're taking a focused look at a crypto infrastructure name that's been making serious waves. Bitfarms. With all the volatility and the really strong momentum we've seen lately, the big question for anyone looking at this space is pretty simple. Is Bitfarms a good time to buy now?
That's exactly what we're aiming to figure out. We've pulled together quite a bit of material covering their fundamentals, the technical side of things, and importantly, where they're headed strategically. And before we jump into all that data, just a quick reminder to you, our listener, please hit subscribe, like the show, and drop a comment below. Seriously, if there's a specific company you want us to examine next time, just let us know in the comments.
Absolutely. We really want to connect what's happening on the charts with, the actual business underneath. So let's kick off with that momentum because the price action here has been, well, pretty aggressive.
It really has. This isn't just some slow, steady climb. We're talking a sustained breakout. The stock recently punched through to a new 52-week high, $3.94. Right now, it seems to be consolidating around $3.64, which is still quite strong. That kind of move, it really signals a potential shift in how investors are seeing the company.
Okay, but we need the technicals to back that up, right? Make sure it's not just, temporary hype. When a stock runs this hard, people get nervous it's already overbought. What are the charts actually telling us about how solid this trend is?
Well, the strength looks confirmed, and that fear of it being overbought right now, it seems a bit unfounded based on the indicators. If you look at the trend, the stock is trading way above its key long-term averages. For instance, it's sitting well over the 50-day simple moving average, which is down at $1.79. And it's even further above the 200-day simple moving average at $1.32. That big gap really does solidify that we're in a dominant uptrend.
Right. And what about that overbought concern? Is there immediate selling pressure likely?
That's the key check, yeah. And the good news there is the stock isn't really flashing those immediate warning signs. We see that confirmed by the 14-day Relative Strength Index, the RSI. It's currently sitting around 42.86. Generally, anything under 70 means the stock likely have more room to run before you start worrying about, frothy territory.
Okay, that's helpful. But we also need to touch on volatility. Our sources show a beta of 4.0. That indicates serious sensitivity to the market. It's a highly volatile stock. How do analysts square that kind of risk with a strong buy rating?
Yeah, that's really the core tension when you're investing in this sector, isn't it? That high beta, 4.0, it just reflects the high growth but also high risk nature of crypto infrastructure. It means, when the market's doing well, Bitfarms will probably capture more than its share of gains. But the flip side is also true. Analysts seem willing to accept that volatility because they likely believe the underlying strategy and growth prospects justify taking on that extra risk.
And they're certainly backing that belief. The consensus among analysts is strong buy. The average 12-month price target is sitting at $4.13. That's almost 20% upside from where we are now. And some estimates go even higher, like 8.36 Canadian dollars. The market itself seems interested too. Look at the volume. Nearly 98 million shares traded recently.
Right, that combination, you've got the analyst backing, those price targets, plus the high volume breakout it suggests. The market might be ready to really recognize the company's foundational strength.
Yeah.
Which naturally leads us to look at those fundamentals. You can't sustain momentum like this without something solid underneath.
Okay, let's shift gears to the financials then. How strong is that foundation? The top-line growth numbers, they're pretty hard to ignore.
They really are impressive. Bitfarms is showing clear acceleration in revenue. For 2024, their revenue hit $192.88 million.
Yeah.
That's a solid 31.78% jump over the previous year. And on a trailing 12-month basis, so the last year's earnings, they're now at $245.66 million. They're growing quickly.
But fast growth isn't always profitable growth, especially in mining. We know they're not profitable yet, so what's the picture on earnings? Where are they heading?
That's correct. No net income just yet. But the progress is really encouraging. So the company reported a trailing 12-month net loss of $86.20 million. That works out to an EPS, earnings per share, of negative $0.17. However, the really critical thing here is the direction. Our sources show that the 2024 losses were actually cut by over 50% compared to 2023. So they are definitely moving in the right direction.
Okay, cutting losses by half is huge progress, definitely. But I want to dig into one detail from our sources that seems, well, pretty sobering. That negative gross margin of negative 6.7%. How can they grow revenue by over 30% year over year but still operate below the cost of just generating that revenue? Isn't that the biggest fundamental hurdle right now?
It is absolutely the central challenge. And you're right, investors really need to keep a close eye on this. A negative gross margin means their direct costs, like energy, equipment depreciation, mostly are still higher than the revenue they're bringing in from mining. Now, while cutting the overall loss shows they're getting more efficient, turning that negative 6.7% figure positive, that's probably the single most crucial metric for investors to track over the next few quarters. It's what determines when all this growth finally hits the bottom line as actual profit.
Understood. So high growth, but cost control is absolutely key. Fortunately, it looks like they're set up for that battle with a very strong balance sheet.
They are, and that financial strength is just crucial in the crypto mining world, given the volatility. Their liquidity looks phenomenal, which gives them a lot of resilience. We see this in their current ratio of 3.11 and their quick ratio of 3.03.
So for you, the listener, what that essentially means is the company holds over 3 times more easily accessible assets than what they owe in the short term. They have the cash to handle market swings or fund upgrades without getting stressed. And are they piling on debt to fuel this growth?
Actually, quite the opposite. They seem to be managing their expansion pretty conservatively. Their debt-to-equity ratio is exceptionally low, just 0.11. This kind of conservative financial management gives them immense flexibility. They aren't really beholden to creditors, which means they can strategically put capital towards future growth. Which brings us neatly to the really big story here, their strategic pivot.
Right. That strong, cash-rich foundation isn't just for defense. It's the launch pad for their next big move. In what feels like a pretty crowded mining space, what's Bitfarms doing differently to build a lasting edge?
There are a couple of key advantages, or moats, as they say. First off, geography. They operate across 4 different places: Canada, the US, Paraguay, and Argentina. Now, this isn't just about spreading out political or regulatory risk, though that helps. It also means they can actively seek out the lowest cost, most reliable energy sources available. And as we know, energy is the single biggest cost in mining.
And that energy focus ties into their broader strategy too, doesn't it?
Yes, exactly. They have a clear focus on ESG, environmental, social governance. Specifically, they're leveraging renewable energy sources and building really efficient mining infrastructure. This is becoming a major differentiator, especially as institutional investors are increasingly looking at the carbon footprint of the whole mining sector.
But the real potential game changer here seems to be the shift towards high-performance computing, or HPC. This is where the company potentially stops being just a Bitcoin miner and starts becoming more of an infrastructure company.
This is what's really fascinating, I think. HPC means they're looking to use their massive energy and computing infrastructure for other demanding tasks. Think AI model training, data centers, complex scientific modeling, things like that. They're essentially leveraging the hardware and energy setups they already have for potentially much more diversified, maybe even higher margin revenue streams down the line.
And it looks like the institutional world is starting to buy into this shift. That massive $300 million debt facility they got from Macquarie seems like strong evidence.
Exactly. That financing isn't just for keeping the lights on. It's a real validation of this strategic change. It's specifically earmarked to develop their Panther Creek project, which suggests that major lenders see them as a credible infrastructure provider, not just a cyclical miner tied purely to Bitcoin's price. And they're building out a huge power infrastructure too, expanding their energy pipeline to around 1.4 gigawatts, with most of that, 80%, concentrated in the US. That kind of scale really changes the business's risk profile. Okay, so we've got strong technicals, high growth, a great balance sheet, and this really interesting strategic pivot. What are the key things, the catalysts, that listeners should be watching for in the immediate future, say the next 0 to 3 months, to see if this bullish story holds up? The most immediate and probably significant event is their upcoming Q3 2025 earnings announcement. That's scheduled for November 12th, 2025. This report is going to be crucial. The market will be looking very closely for 2 main things. 1, progress on that negative gross margin, or the improving cost control. And 2, updates on how the deployment and the early results of the new HPC strategy are going.
And outside of their own results, what external factors matter?
Well, obviously, any sustained positive movement in Bitcoin's price provides a direct tailwind. It boosts mining profitability straight away. We should also keep an eye out for ongoing operational updates, things like expansion into new geographic areas, or any news about potential strategic partnerships, especially related to that HPC infrastructure build-out.
Right. Now, to keep things balanced, we have to talk about the risks. What are the main threats that could potentially derail this positive outlook?
The biggest risk is probably sector-wide, just plain market risk. Because of that high beta, the 4.10 we mentioned, the stock is highly sensitive to Bitcoin's price swings. If Bitcoin takes a sharp, prolonged hit, Bitfarms is likely to fall harder and faster than a lot of other stocks.
And what about risks specific to Bitfarms' own operations?
Yeah, company-specific risks include, well, the volatility of energy costs, that's always a factor, and the critical need to improve profitability. That negative gross margin is a constant pressure point they need to fix. Also, just generally in the mining sector, there's always this constant need for significant capital investment to keep the mining equipment up to date and competitive. That's an ongoing cost.
Okay, so pulling it all together then, what's the final take for someone listening who's considering buying Bitfarms right now?
Based on everything we've looked at, the overall investment picture appears overwhelmingly bullish, I'd say. We'd assign it an overall bullish rating, maybe an 8 out of 10. The rationale really comes down to that combination of strong fundamentals, particularly the 31.78% revenue growth and that exceptional financial strength layered on top of really powerful technical momentum. The stock is breaking out, and that strategic pivot seems validated by significant institutional financing.
So is this opportunity more for a short-term trader looking to play the catalysts, or is it better suited for a long-term investor buying into the infrastructure story?
It's actually quite interesting because it seems potentially attractive for both. Short-term traders have clear triggers coming up, especially that November earnings report. That's going to either confirm or challenge the current efficiency narrative pretty directly. But long-term investors, they're positioning themselves in a company that's trying to fundamentally reshape its business model, moving, potentially, from being just a volatile miner to becoming a more diversified, maybe essential infrastructure provider for the future of computing. In this transition, it brings up a final thought for you to consider. Given their strong balance sheet and their operational know-how, Bitfarms isn't just stable. It could make them a really attractive partner, or maybe even an acquisition target, in an infrastructure sector that's likely to consolidate over time. So how might the success of this new high-performance computing push actually accelerate that potential M&A activity? And how could that fundamentally change the company's valuation, making it less dependent solely on the day-to-day price of Bitcoin? That's the strategic long game that perhaps the market hasn't fully priced in just yet.